Hi and welcome to Swissquote's Daily Market Talk. It's Monday, November 25th. The Trump optimism continues to support the US equities, the US dollar and cryptocurrencies, while the European assets are dealing with the soft economic data from Europe that some investors out there see as a good thing due to the softening European Central Bank expectations. But the ECB alone could hardly give the European businesses a strong basis to thrive in the long run. Europe likely needs much more than just a monetary support to get back on its feet. So last week was marked by an improved sentiment in the US, but not so much in Europe. Because the US equities had a good week, the S&P 500 rallied 1.68% over last week, Nasdaq 100 gained 1.87%, and that despite Nvidia that finally closed the week flat as its earnings announcement disappointed investors, and that disappointment kicked in with a small delay on Friday and costed the company more than 3% retreat on Friday. Then the Dow Jones rallied nearly 2%, while the small caps rallied nearly 4.5% last week on further rush to Trump trades. So, SPDR's energy and financial ETFs hit a record high last week. The US dollar index rallied to the highest levels in 2 years. And of course, Bitcoin, which is the ultimate Trump trade, flirted with the $100,000 per coin psychological mark and consolidated gains a little below that level during the weekend trading. Now, at this coast of the Atlantic Ocean in Europe, things looked much less encouraging, to be honest. First of all, the STOXX 600 index tipped a toe below the 500 mark at the start of last week, and even though Friday ended on quite a bullish note for the European equities, the move was driven by a bad news is good news for the markets type of motivation. Because the economic data released last Friday in Europe looked all but encouraging, guys. Growth in Germany slowed in the third quarter, and the yearly figure printed a faster contraction of 0.3% versus the expectation of a stable contraction near -0.2%. The PMI numbers came in lower than expected. The flashing red French numbers, especially the unexpectedly fast deterioration in the French services sector, actually pushed the Eurozone services PMI and its composite PMI as well into the contraction zone unexpectedly. Now, obviously, that very bad looking set of economic data from the Eurozone boosted the expectation that the European Central Bank will cut in December and could opt for a 50 basis point rate cut rather than a moderate 25 basis point one to try to catch a falling knife. And that economic growth doesn't necessarily mean a stock market demise, but it's still quite hard to bet that the European company valuations that actually trade with a 40% discount on their S&P 500 peers in terms of PE valuations will get better before they get worse. Because first, the lack of innovation in Europe and the extremely crowded regulation and rules in the Euro area makes it extremely difficult for the companies to do business in Europe, and that's something that the European Central Bank cannot solve with lower rates. Second, the luxury goods companies in Europe contribute to around 8 to 10% of the European market capitalization during strong market periods. In France, the luxury stuff makers stand for more than 25% of the CAC 40's market cap, making it one of the most heavily weighted sectors in this index. And this percentage of luxury good makers is around 10 to 12% for the MSCI Europe. And because these luxury companies need a strong demand from the EM markets, especially from China, which is their biggest market, the fact that the Chinese economy is not doing great these days is not good news. And add to that the fact that the European policymakers are doing everything in their power today to escalate their trade tensions with China by imposing their companies big tariffs. Remember, it's quite hard to give a positive outlook for the European luxury makers. And unfortunately, the same is true for the Eurozone's car makers, having missed the EV term. And these escalating tensions with China are obviously not having a good impact on the German car makers either, because the industry is facing a massive crisis right now, the biggest since the Second World War. And even the ECB chief Christine Lagarde said at last Friday's European Banking Congress that, well, since last year, she said, since last year, Europe's declining innovation position has come more clearly to light, and that technology gap between the United States and Europe is now unmistakable. And she was probably not seeing since last year because Europe has been trading behind since a while now. So her comments echoed Mario Draghi's call for this 800 billion euro worth of innovation fund that the European countries should finance together, remember, with a sovereign bond scheme to compete better with their US peers. So yes, the lower company valuations in Europe and this growing valuation gap with the US companies do attract some investors right now, with the prospects of lower interest rates in Europe and elsewhere as well. That is also expected to support these cyclical European companies. Yet the European economic tissue actually needs more than just the European Central Bank and elsewhere cuts to get back on its feet, in my opinion. It needs deregulation and perhaps some international cooperation wouldn't hurt. And because Trump is expected to escalate the trade war with Europe and impose tariffs on the European companies, well, the only option that actually looks good is being friends with China again for the Europeans. And because that is not happening in the short run, I am not necessarily thrilled by the European stocks at this point in time. Voila. In Europe, I like the Swiss and the UK markets better. Swiss, because of its neutral and defensive nature and stable economic and political environment. And the FTSE 100 because of its financial, energy and commodity focus, well, which is quite interesting indeed in a period of easing monetary policies around the world. And the big dividends that its companies pay out are actually interesting to hedge against a potential uptick that we might see in global inflation that could eventually jeopardize the easing monetary policy plans to some extent. Anyway, in the FX markets, the US dollar surge last week, combined to the weakness of the European economic data, sent the euro dollar to a dark hole, really. The pair tanked to 103.30 level on Friday and rebounded strongly after hitting that dip and is consolidating near the 104.80 level at the time of talking here. Now, I actually expect some more consolidation and dip buying near the current levels in the euro dollar from the tactical longs, because if nothing, we could eventually see the US dollar give back a part of its strength in the first few trading days of this week, as it will be a holiday shortened week for the US due to the Thanksgiving break. So all news and data points will actually be concentrated in the first 3 trading sessions of this week, with FOMC minutes due Tuesday and growth PCE figures and jobs data due on Wednesday. Then the European countries will start releasing their November early inflation numbers from Thursday on, and the strength of the data there will either cement the expectation of a 50 basis point cut from the European Central Bank in the December meeting, or reverse these expectations and give the euro a certain positive swing. But as I was saying last week already, further sell-offs that we might see in the euro dollar are probably good dip buying opportunities below the 105 psychological mark. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.